Hello everyone and welcome back. In today's video, I'm going to talk about investment plan. Yes, you must have an investment plan in place before you start investing. So let's understand what are the basic components of an investment plan, or what is it that you need to do before you start developing an investment plan. The steps to develop an investment plan is the first thing that we are going to discuss today. After that, I'm going to talk about the various kinds of goals that you can have and how you address those goals. And lastly, we'll talk about retirees. So let's first look at the steps to prepare an investment plan. This first step will be for you to be clear about your current financial situation. When I say current financial situation, I really mean what is your financial state as on date. How much assets do you have? What are your liabilities? What are your incomes and what are your expenses? So really you're looking at your balance sheet and your P&L statement. When I say assets, I mean anything that you own. What you own is your house, your jewelry, the cash balance that you have. And when I talk about liabilities, I really mean the loans that you have. If you have any loan against the house property, if you have a loan against gold, all those things would be your liabilities. Then you have to think about your cash flow stream. What is the income or what is the cash inflow that you're receiving? It could be your salary income. It could be income from house property in the form of rent. It could also be income from your savings in terms of interest received on your deposits. And then comes your expenses. Where does all the money go? Where does my salary go? I ask myself at the end of every month. But that is it. That is your household expenses. It is your children's education. It is your traveling expenses. There are so many expenses. But all you need to do is list them down so that you have a clear view of what your current financial state is. The next thing that you need to ask yourself is, what are your goals? What are your short-term goals? What are your medium-term goals? What are your long-term goals? Lastly, you have to understand risk. You have to know what kind of an investor are you. Are you a conservative investor? Are you a balanced investor? Or are you an aggressive investor? So how do you ask yourself the question? There are a lot of questionnaires that you can find online. Now, you just have to type in Google questionnaire for financial planning and a lot of questionnaires will come. If you pick up any questionnaire, it will have a set of 20-25 objective questions. All you need to do is tick them, answer them, and then at the end of it, it will tell you your risk profile. So you must understand your risk profile before you build up your investment plan. With these three things set, you should be ready to start making your investment plan. Now, before moving to the next presentation, which is on investment types and on investment plans, I want to discuss a little more in detail about the kind of goals and how you're supposed to define your goals. Let's first talk about planning for short-term goals. What are short-term goals? Short-term goals are your financial goals for the next 1 to 3 years. That is, what are you going to spend in the next year, the year after? It could be a domestic holiday, an international holiday. It could be making some purchases. It could be giving a big gift to your wife or to your husband, whatever the case may be. But before talking about short-term goals or your immediate needs, before saving for them, you have to adopt a very intelligent strategy in which you will be able to invest regularly. And to do that, you have to first make sure that you have gotten rid of all of your pending credit card bills, all of your personal loans, etc. And that is really important because you may not be able to save as much money as you can in any other situation because the credit card bills and the loan EMIs account for a huge part of our expense. Then you have to plan for a regular saving investment into planning for your short-term goals. So after you know that you have cleared all your bills and all, and you know that 2000 rupees is what you can save monthly in order to meet your short-term goals, that is what you have to start planning, and that is what you have to start keeping aside for meeting your short-term goals. Lastly, you also have to choose an investment. You have to choose an investment which will make sure that you have the money at the end of the period to fulfill your short-term goals. Now let's see how you will select that investment. Now from now on, whenever I talk about investments, I will talk about an investment in terms of three parameters. The first being risk, that is how much money can your investment lose, or what is the probability of losing money on that investment. Second is volatility. Volatility is the ups and downs that your investment sees. How volatile can an investment be? So how many times in a year, how much percentage do you expect it to go up or to go down? So any change in value, be it positive or negative, is called volatility. Lastly is expected returns. And expected returns is what we are doing all this for, to get a return on our investment. So risk, volatility and return are the three parameters on the basis of which from now onwards I'm going to discuss an investment with you. So a short-term investment must have low risk, it must have low volatility. And if risk is low, you cannot really expect a very high return. So you will be expecting a conservative return on your investment. And the suitable products for a short-term goal would be just keeping the money aside in your savings account, or to invest in a term deposit. You should keep the money aside in your savings account if you're not sure about when you may need to take out the money. But if you are sure that of the time period, if you know that you may need the money only after 1.5 years or only after at the end of 2 years, then you can consider putting your money in a term deposits. Both these options are safe, but both these options have low return. However, you have to ensure that when you put your money in a term deposit, you do not let the investment roll over to the next period. Because if that happens automatically, you may not be able to serve the purpose. The investment may not be able to serve the purpose of your short-term goal when you need it. Now let's see what is our next discussion point. That is planning for medium-term goals. And what are medium-term goals? Medium-term goals are really anything that you may be saving for in the next 4 to 6 years. Now for medium-term approach, you need a balanced approach. That is, you are thinking about a fairly high rate of return, that is higher than what your bank is going to give you, but you are still not willing to take a lot of risk. Because if anything was to go bad with your investment during the next 4 to 6 years, you may not have sufficient time to correct it. So that is why you have to look at investments in a balanced way. You are looking at growth, you are looking at high return, but you are still trying to play safe with your investments. So any investment which meets the criteria of a medium risk or a low to medium kind of a risk, a low volatility or a medium volatility, I would say something that could be volatile enough to change in value of up to 20% in a particular year is something that I would call a medium volatility product. And a return of say about 10% is what you're looking at. So even if your investment was to go down a little bit, still you have 4 to 6 years. Still you have time to regain the value back in capital. The kind of product that I would suggest for a medium-term goal would be a balanced investment option of a managed mutual fund. So there are a lot of managed mutual funds in which they have a combination of different products which gives a balanced approach in terms of income as well as growth. They are not very aggressive and they are suitable for mid-term goals. Let's now look at long-term goals. Long-term goals would be something that you're planning over a longer period of time. Though I've mentioned here 7 years, but when I talk long-term, I really mean 15 years, 20 years, that kind of a thing. So for a person who has just started his career and is planning to save for his retirement, and of course it will be a very intelligent thing for him to start thinking now, would be looking at a time span of 30 years. Now in India, most of the investees are really self-funded retirees. Unless and until you are in a particular job in which the employer will give you a decent amount of retirement income with which you could spend your retirement years comfortably. most people will have to fund their own retirement, and those are the kind of people that I'm going to talk about. Well, when you have a long horizon, when you have 15 to 20 years ahead of you for making your investments, then you can really look at taking high risk, because even if your investment was to stay low, or if your investment was to go down for a period of 4 to 6 years, still you have about 15 to 20 years to recover back from that and bounce back well. Volatility, again, there in high return products, there could be very high volatility, or in growth products, there could be really high volatility. And we are talking about a change in value of up to 40% in any particular year. But again, because we are not restricted by time span, we do not want to take out this money in the near future, we can really bounce back from that kind of volatility, also even if it is negative volatility. Expected returns, of course, could be really high. You could look at expected returns from 12 to 15%, or even more if you invest right, if you invest in the correct products, if you monitor your portfolio regularly. Now, a suitable approach for long-term investors is an aggressive approach. I always recommend my long-term investors to invest in very high growth or high growth products. Take a very aggressive approach here, take a lot of risk, because that is when you will get a lot of return. If you take a lot of risk, you could look at high growth or growth managed funds. You could look at high growth or growth superannuation funds. You could also look at buying growth stocks or growth bonds. One of the good parts about buying growth stocks or growth stock mutual funds is that in India at present they are tax free. So that means return on stocks and return on stock mutual funds is tax free. So even if you make, say, a 20% or 30% or even 100% profit, that is entirely tax free for individuals. So that is really a good thing for you, and that is why I always tell my long-term investors to invest very aggressively into stocks. Lastly, I would like to talk about retirals. So if any one of you watching this video is going to retire soon, is approaching his retirement, I would really not suggest any of the approaches that I talked about previously. Because when you're retiring, you are really thinking your income is going to stop. Income that you are receiving from your current job is going to stop. So you're really looking at generating income from your investments. So for retirees, you have to think about what income is your investment going to give you come the next 4 years, 5 years, 10 years, whenever you're going to retire. Again, you don't have very long time to your retirement left, so you cannot take the aggressive approach that I had just suggested for the long-term investors, especially in case of retirement planning. So that is not an approach that I'm going to suggest to you here. What you need to do is that you need to make a good financial plan. You have to lay down what kind of expenses are you looking forward to at the time of your retirement. And you have to put your investments in place such that the investments stay safe, but they are able to give you a return good enough to fund your retirement requirements. So we have to, for people like you, we have to really look at products with a moderate risk, which have a medium volatility, and still which have a decent return of about 10%, so that you can fund your retirement income well. A suitable product could be a market-linked pension account, something like the NPS. You could put your money in NPS and choose what kind of risk you're willing to take. There are a lot of private pension plans also which are linked to the market, so you can choose how much risk you're willing to take. They give you various options of high risk, low risk and medium risk. Depending upon your risk-taking ability and your willingness, you can choose the kind of retirement plan that you want. But your retirement plan should be able to give you income as well as some capital growth over the period of time. Well, that is it. That is the end of this presentation. And in the next presentation, I will talk about various investment products. And once you have an understanding of the investment products, I will teach you how to make your own investment plan. I will walk you through making an investment plan for yourself. Thank you very much. Looking forward to seeing you in the next presentation. Again, if you have any questions that you would like to ask me, please feel free to write to me at tanujayadav@yahoo.com, or you can even reach me on my LinkedIn email ID. Thank you very much.